Good morning, everyone. Darius Starr here to welcome you to the Hedgeye Risk Management Morning Macro Call for Tuesday, November 25th, 2014. Before I turn things over to Keith, allow me to briefly touch on asset allocation. Take our cash position down to 64% from 65% day over day. U.S. equities, international equities, and commodities each held flat at 0%. Foreign exchange held flat at 5%. And fixed income, we took up to 31% from 30% day over day. As always, if there are any questions, please email qa@hedgeye.com. With that, take it away, Keith.
Thanks, Darius, and good morning. Top three things in my notebook this morning. Number one, the price of oil on the bounce. Number two, Russian stocks and the Russian ruble. And then finally, we'll hit on the 10-year bond yield and its read-through on global growth. So first, if you look at oil, you look at the complexion of the bounce. Why did we bounce? We got the Chinese rate cut. So again, we're running out of central plans at this point, but central plans do have impact, and a lot of people bought the inflation trade on Friday on that. So again, you have to study the complexion of the bounce of something like oil, which is definitively crashing. Again, the top end of the risk range is currently right around 77.5, and there's no support to just inside of 73.50. So again, in other words, oil could go back to 73.50. And again, that's why point number two today would look like it looks. Again, the Russian ruble's down another percent. That has crashed year to date. The Russian stock market, as you know, has crashed for the year to date, down 23.3%. And it's also leading losers globally. So again, the question remains as to whether or not deflation is being priced into both equity and bond markets. So again, for the third point, you'd have to look at the 10-year bond yield on that. Now, the 10-year bond yield says definitively between Japan, Europe, the USA, Russia, and back again, that global growth is slowing. When global growth slows, bond yields fall. You can see this. You can see this even in European bond yields. Spain has had a huge drawdown in the 10-year bond yield there. But on the 10-year U.S. Treasury yield, no support really to 2.22%. And again, with a newsy headline that GDP beat sequentially, you want to be buying more bonds on that. Again, the fourth quarter GDP comparison is the toughest of the year. The way that we model GDP is year over year. We don't look at the sequential seasonal. Again, that's the point. We're sticking with it. Growth surprising on the downside. It's right about half of what consensus thought it was going to be 10 to 11 months ago. So again, 10-year bond yield lower, buy TLT, and smile. Those are your top three things. Now, it's the morning show, so we're going to go through all the risk ranges. Again, we're going to go through the complexions of risk on a price volume volatility basis. Again, if you're following the moving monkeys on mute, again, you will not get anything about volume or volatility associated with that. So again, looking at price volume volatility, a three-factor model, that's just the most basic model within the model. And again, we have another 27-factor model that correlates and or looks at the interpretation of correlations between things like China and copper. There's 27 big macro things in that model. But again, just to take a step inside of the three-factor model, we generate a risk range. So again, the S&P 500's risk range is currently 2018 to 2072. Now, as most of you know, last week was the first time that I came back and shorted the S&P 500. So again, I will be shorting SPYs with a timestamp today if in fact the SPYs are up, because again, anything over 2072, we call that the top end of the risk range and or a selling opportunity. So again, if you're looking at the Russell 2000, which we currently do not have on as a short in real-time alerts, I'll be looking for 1187 to 1190 on the immediate term trade over bot line. So that's immediate term trade over bot. For the Russell, the low end of that risk range is right around 1154. So again, what we want to be doing in the Hedgeye process is selling high and covering low. So again, we've done this repeatedly. It's a process. It works. It's a good way to fade the moving monkeys, or in other words, it's a good way to fade momentum chasing. So again, you do need a risk management strategy on the other side of that. Momentum is a strategy. Everybody knows what the strategy is. It goes down in a ball of flames eventually. In the meantime, all you can do is sell high and buy low and like it. So again, looking at volatility, if you start to look at this in terms of front month VIX, for example, front month VIX, the immediate term risk range is now 12.49 to 15.68. So again, that looks like what? That looks like the upside down of the S&P 500's risk range. So the S&P 500 will hit the top end of its risk range as the VIX hits the low end of its risk range. It's the same signal. These things are inversely correlated. So again, when the VIX gets oversold, you sell beta in equity land and you buy protection. So again, that's a good idea if you can buy VIX calls to the upside. Again, VIX would have to break 1134 for us to say that there's a regime change back to the downside. Again, we've been making a bullish call on volatility really since the first week of July. We called it volatility's asymmetry. We have a beautiful slide deck to go alongside that. That, by the way, is when all of global volatility, including FIC or fixed income, currencies, commodities, fully loaded, it hit an all-time low in volatility. So again, I can't imagine what could possibly go wrong with the entire world slowing in the face of volatility hitting all-time lows, but you already saw the preview of that, which was the big September to October drawdown, which a lot of people have conveniently already forgot, which we will not. Advanced decline line yesterday was interesting. That's something to look at. If you look at the all-time highs in the SPY, it's not really broadly seeing a participation from a breadth perspective. Now, only 59% of stocks were up at the all-time high. At the same time, volume was continued to decelerate on the up move. Now, a lot of people would say, well, that low volume doesn't matter. It's the same people that if you looked at their tweet stream on September the 18th, September the 19th, September the 22nd, September the 25th. Again, I would be on this call saying this. Again, you're getting decelerating volume signals as the market goes up. That was a clean-cut sell signal. It was then, it is now. And again, you won't really have them agree until they're in the fetal position. So again, 150 points of drawdown in the S&P came from that signal. We could have 200 points of S&P drawdown risk from here. So again, look at for what it is: price, volume, volatility. Volume yesterday, total U.S. equity market volume was, get this, down 29% versus the year-to-date average. So again, volume is crashing, oil is crashing, bond yields are crashing. It's all good, right? All good. No worries. No worries, Darius. No worries. Unless, of course, you're long energy stocks, which sucked yesterday, down another 0.8%, and XLE, which is the energy ETF, is down for the year to date. Now, looking at Asia, again, looking at risk ranges and levels. If you wake up to the green arrows in the morning and all you're doing is looking at a couple things and it takes you 3 minutes, this call is not going to be for you. I spend 3 hours going through it all just because I'm not as smart as some of these day traders. But again, if you look at what happened last night in Asia, it wasn't really green arrows. In fact, if you were only looking for the color, I mean, God forbid that's what you do, but if you're only looking for the color, there was red in Hong Kong, there was red in India, there was red in Indonesia. Imagine all those red arrows. Again, what's actually going on in Asia, as you know, is that the two green arrows are in the markets that have the two biggest and most recent central plans. So again, Japan, green arrow. Again, the Weimar Republic had a green arrow in 1924. So again, Weimar Nikkei is what we're calling that. That's up 20% since October the 17th in a straight line. And if you didn't have the central plan, it would be straight down. So again, don't mince any words about this. The worse the economies get, the higher that market's going. China, same thing, up for the fourth consecutive day. On what? The central plan. So again, that was another market that was up. The rest of them pretty much flat to down, with the Kospi flat to down as well. Now, looking at Europe across the board, again, what is the catalyst? It's certainly not growth. I mean, let's just be honest with each other here and say the catalyst is that the economy sucks so badly that we have to have quantitative easing. If you can't just say that, then you're lying to yourself. That is the only reason why European equities aren't going down right now. So again, December the 4th is the ECB meeting. People are attempting to say that Draghi could walk on water at that point. That means that the risk starts to accelerate as stocks accelerate to the upside to the overbought signals. So we're seeing an immediate term trade overbought signal not only in Germany this morning, but in France. France is much preferred on the short side. We love shorting socialism. We don't think that it's a better idea to go with Germany. We'd much rather you stay with EWQ, which is, of course, shorting socialism in French terms. So again, immediate term trade overbought line, if you're keeping score, for the CAC 40 is 43.88. And for the German DAX, just inside of 9,900 is the immediate term trade overbought signal as well. Again, overbought within the range. You don't buy there, you sell there. I don't care what it is. As long as it's ticking, that's how you think about the risk management of our process. Now, looking more broadly away from just Russia, Saudi Arabian stock market's down this morning. Norway's down this morning. Greece is down this morning. What do all these things have in common? They're either illiquid and dysfunctional, like Greece, down 15% for the year to date, or they're linked to inflation expectations. So, inflation expectations is today's chart of the day. We show it, maybe we can put it up here right now, but if you can't see it, it's on the site. Again, break-evens. The jabronis can't tell you what break-evens or tips are. I can assure you that they can't tell you what yield spread compressing means either, but I can tell you one thing. They're all telling you that both growth and inflation expectations are falling. at this point. So again, that's why these petrodollar-oriented markets are weak. That's why you're seeing risk develop across the world from a deflation perspective. Again, people are baking in deflation expectations, and when people ask me, what is your catalyst? It's already happening. I mean, I don't just wake up and feel negative about things. Deflation's getting priced in. So again, look at the commodity complex more broadly. We talked about oil quickly, but again, the CRB index, which is 19 commodities, down another 0.7% yesterday. Again, they went up on the Chinese news on Friday and then straight back down. Looks like the CRB index is going to make lower lows. Looks like copper is going to make lower lows. Again, as oil does what it does, we've already said, that looks like it's going to make lower lows with no intermediate term trend support, which is different than intermediate term for the price of oil towards 64 to 65 for WTI. Now, 10-year risk range on the bond yield, just to hit on that quickly, is now 2.28 to 2.34. So again, on any single and any definitive headline that you can see from the financially manic media that growth is back, you buy bonds on that. I don't know how, I mean, we're running out of days here, Darius. It's November the 25th. I've only been saying this every day for the entire year. So again, when they say that growth is back, you buy the bonds because the bonds are down usually on that. Now, they weren't down this morning. I'll have to see what they did on the GDP report. I can't talk and look at live quotes at the same time. Maybe we're going to have to get somebody else to do that while I'm ranting. Now, away from that, economic data points are pretty light this morning. PPI in Spain, interesting but not surprising. And again, this is the point on deflation. The central planners have inflation targets. So again, they want to get the 2% inflation, and they're not going to be able to get it. So this is the beginning of the failure of central planning. After they've all cut to zero, you can see it in the Spanish producer price index, again this morning, down 0.2% year over year. Forget the rate of change, which is obviously negative. You can see that in any CPI or PPI chart across all of Europe at this point. And for that matter, you're going to see that in the US as well. But again, they have deflation already. They're trying to resuscitate inflation, and the market doesn't buy it. The market is pricing in more deflation. So again, who is deflation bad for? It's bad for the debtor. It's bad for those who are long inflation expectations. You can be long those via tips. You can be long those via junk bonds. You can be long those via a junk bond that has an energy asset base behind it. It's the same thing. So again, watch out. Deflation, we call it quad 4 deflation. I think it's been one of the better calls we've made throughout the year from a theme perspective. And again, we suggest you stick with that. On the other side of that, there's a lot of things to do on the long side, which include on the U.S. equity side, we like healthcare, consumer staples, REITs, and utilities. So maybe a good spot right there, Darius, to take some questions.
Absolutely. First question here says, we're interested to see how you now foresee a move to the bullish first quadrant in the first quarter of 2015. Is this because you foresee a major crash in the meantime, or because you think we will avoid the crash and move into quad 1 anyway?
Well, quad 1 is just math. You know, you can go to, so what the question is from an institutional subscriber who understands our model. So again, we have 4 quadrants, and we're currently in the 4th quadrant. And again, just to explain this as simply as I can, you start with rate of change, again, as a mathematical concept. So again, it's a second derivative move. Rate of change is either slowing or accelerating. Currently, we have both growth and inflation slowing. That's the 4th quadrant. The question is, when inflation slows enough, you get growth accelerating. So in other words, you get a tax cut, consumers start to party in the streets, and again, you start to get some consumption growth. This is exactly what our call was in 2013 when we were bullish. So again, we were in the 1st quadrant. Now, to get to the 1st quadrant, you have to go through the path, which includes the 4th quadrant. So again, my answer on timing, Darius, is that you would have to have a market event to really get you the good kind of a quad 1 event. Plus, you'd have to see interest rates rising. Typically what happens in the 1st quadrant is that you get the dollar up and interest rates rising, which is very much a pro-growth signal. It was between 1983 to 89. It was between 1993 to 1999. It was in 2013. It was in 2009. That's why you'll see Hedgeye be bullish on growth when that indeed happens. So again, I'll be looking at interest rates very, very closely on the 10-year bond yield. When I sell my bonds is effectively when I think we're going to be in the 1st quadrant.
Cool. And then just a follow-up question. So are you going to say you're staying long TLT?
Yeah.
Yeah, cool. And then just a couple quick ones here. When do you think Europe turns around?
Oh, geez. Europe is not turning around anytime soon. I mean, so the problem with Europe, and again, if you just go to the model, again, we think of things in rate of change terms versus the comparative period. So let me say that again. When we make a call on something, we look at the rate of change versus the comparative period. Some people call those the comps. Now, you might know that if you're a bottom-up stock picker in retailers or restaurants, people talk about the comps or the same-store sales. So the same-store sales or the comps or the comparative data series for Europe gets tough all the way into the third quarter of next year, because of course Europe didn't start to slow until the third quarter of this year. So again, that's the problem with Europe. They're going to be looking like they're slowing at an accelerating rate no matter what Draghi does, no matter what the stock markets do, no matter what the bond markets do. This is the point about central planning, Darius, is that they don't get the real output of growth. What they get is the illusion of growth. Now, that's what people call the attempt at policies to inflate, is that they get stock markets and sovereign bond yields or sovereign bonds to go up, and they don't actually get economic growth. So that's what I think is going to happen in Europe. You're going to have a deflationary force in Europe for at least the next 9 months.
Indeed. Do you still think oil is going lower?
Yes. So we went through that at the top. Again, oil we think is the leading indicator. We do not think you should be ignoring the deflationary signal that is oil currently.
Cool. Any plans to buy Restoration Hardware before earnings on pullbacks?
Well, we're not big on, the timing of quarterly earnings catalysts and stuff like that. I mean, so you take something like Restoration Hardware, we obviously like it. It's a high short interest stock. Brian McGough's liked it for quite some time. This is a thing that you should look at, obviously, within its risk range. So in Investing Ideas, which is our longer term longs, we have Restoration Hardware in there. And what I do every weekend in the Investing Ideas letter is I provide the intermediate term range. And again, it's right back to the process, Darius. I like to buy them at the low end of the range and sell them at the high end of the range. Not all of it. If I'm running a portfolio, which I used to do, that's what I'd do. I'd have a 5% position at the low end of the range, and I'd have a 2.5% position at the high end of the range. You sold half at the high so you can buy it back. So that's the point. Restoration Hardware currently, the intermediate term range, if I can just pull it up here quickly, this might be lucky if I can get this to give this to me. Just 1 second here. Maybe 10 seconds. Trying to filibuster here. Okay, the risk range, if I just keep saying nothing, I can tell you that I'm going to get to the risk range. By the way, if you want to watch Consensus TV, they say nothing for like 30 minutes on end. But again, 10 seconds is enough. Restoration Hardware's intermediate term risk range is currently between 79 and 86. So the stock's at 85.4. You don't buy at 85.4. You buy it at 79.6. Or in October, when the bulls are on their knees, you could have bought Restoration Hardware at 73. But this is the problem with what's going on out there right now. Nobody really wants to invest when they know that the music stops. They'll sell everything. They sold everything like this on October the 13th, 14th and 15th. And then when they're up, they'll buy them. They buy high and they sell low. I mean, I don't know how useless that is, but that's why I antagonize so many of my furry friends on Twitter.
From Twitter. When did you guys take off the Russell short?
That's time-stamped. I hope a subscriber can tell you when it was, but it was on the pullback. When the Russell, okay, to review, the Russell, not including this week, the Russell is down, or hadn't had an up week in the last 3 weeks. At one point in the week last week, the Russell was back to negative on the year to date. We covered that. Again, it was the immediate term risk range. So again, I think the macro days of people waking up in the morning at 8 o'clock and saying, oh, I like the spoos, or I like, I'm going to do this, or I'm going to do that, or I was always bullish, or I was always bearish. I mean, give me a break. Get yourself into a risk range setup. Tell me what you like and you don't like. I like the long bond. I buy it at the low end of the range. I sell it at the high. I do not like the Russell. I sell it at the high end of the range. I cover it at the low end of the range. So that's what we did in the Russell, so that's good, because this morning I can reshort the darn thing and smile about it. The Russell 2000, just newsflash, is still down 2% from its all-time high, which is made on July the 7th. So in other words, if you're this guy who's bought every single, I don't know, if you buy them every time the Russell goes up, you're still down. That's the point. You don't want to be doing that. You want to be a little bit smarter than just talking about the spoos going up. You want to think about macro in terms of what you're trying to express, which is indeed growth slowing. And the best way to express growth slowing is in small to mid cap bubble stocks, which is the Russell, and to buy the long bond. So again, I don't know how many more ways I could say this.
Cool. Couple good ones here. Do you make anything of the Swiss Central Bank voting to double its gold holdings and within 5 years hold 20% of its reserves in gold? Does this change sentiment or the price decline in the commodity?
Yeah, I think if they voted for it, obviously that'd be a pretty epic event. A lot of people are talking about this. As many of you know, people are quite religious about gold. We're not. We like to look at it within the framework or the prism of what macro markets are telling us. And currently, it's really hard to get really bullish on gold with the dollar going up. And the dollar still looks fantastic. Why? Because the yen and the euro are being burnt to a crisp. So again, that's not a bull case for gold. A bull case for gold would be the dollar being burnt to a crisp, which, by the way, is going to happen, we think, in the first half of 2015. That's the bull case for gold. If you're looking for a bullish catalyst, obviously the Swiss catalyst would be bullish, but the real bull catalyst for gold would be to get Janet Yellen to say, I'm not raising interest rates this year. See ya, and move the dots out to 2016. That's when gold really starts to go up again, and hopefully we can time that right. For now, we don't have a position.
Cool, and then we'll end it with this one. Can you provide some commentary on the differences in the global economy and global markets? Does your macroeconomic views always align with market prices?
A great question. I mean, no. Again, newsflash, the economies are not markets right now. We have centrally planned markets to solve for a political economic issue. So again, do not confuse these things. I don't have to tell you to read. Actually, you could only read the last 6 years of history and you'd still get it. But again, if you read all of economic history, you will note that when countries like Venezuela, like Argentina, like the Weimar Republic in Germany, like Japan is doing now, they can burn their currency and their market can go up. But they're doing that in reaction to negative economic results. So the economy and the markets are like this. This is why we have inequality like this. I don't know if I'm showing it accurately, Darius, but it's like widening. It's called inequality. It's called wedge. Because what you're doing is you're pounding the poor people in exchange for those who can outrun the poor bastards and get long the asset prices and not be long the economy. So again, the real economy is what struggles, and these things are completely different. And again, most people who haven't read history would be like, what? The chart, like I say it all the time, it's a bad joke, but if we had Twitter and it was 1922 to 1924, you'd have a bunch of these yodels in New York City telling you how the Weimar Republic chart looks fantastic.
Indeed, they would. We'll wrap it up there, folks. Thanks for joining us this morning. We'll catch you back here tomorrow, same time. Have a great day out there.